The number one thing that you have to be able to do to be successful in this market is adapt. Hey guys, welcome to a championship edition of Wealth Talk. Yep, after 32 years, the Dodgers have finally won a World Series. And we're going to talk a little bit about how some of the things they've done to win that World Series actually translate into the market. The number one thing that you have to be able to do to be successful in this market is adapt. So let's talk a little bit about the Dodgers first. Being a longtime Dodgers fan, it's been a long 32 years. But look, 3 out of the last 4 years, they made it to the World Series. Dave Roberts has took his team there, but they came up short a couple of times. They came up short against Boston. They came up short against the Astros. And, look, at the end of the day, they're going to say the Astros cheated, this, that, and the other thing. But there's really no excuses in baseball. There's no excuses in business. And so what I want to do is talk a little bit about some of the things that Dave Roberts has done. One of the things he got a lot of flack for was sabermetrics. So something that baseball has really gone to today a lot is this very technical way of playing sports. So they're looking at velocity, spin rate, they're looking at left hand on left hand in terms of pitching versus batting. And what they're trying to do is take what maybe some said years ago was a game of checkers and turn that into a game of chess in baseball by making the right matchups from inning to inning. And I think a lot of people, including myself, don't believe, just like in investing, just like in business, you can take a purely technical approach and be successful. We saw that, I think, in the last few years with the Dodgers. Like I said, they came up short a couple times in a row. They got all the way to a game 7 against the Houston Astros by playing this very technical level of baseball. And I think Dave Roberts, by having that experience, really understood that being technical all the time doesn't really matter. And if something is not working and you're doing it time and time again, you have to be able to adapt and overcome that. And I think we saw that technical play yesterday, Tuesday, in game 6 by Tampa Bay against the Dodgers. And we saw the Dodgers as playing good old-fashioned fundamental baseball. And so what happened is through 7 innings, their ace, their pitcher Snell, basically had the Dodgers tied up. 1 hit going into the 7th inning, and then there was a second hit in that 7th inning by the catcher Barnes, took it out into center field. And what happened? Their coach, thankfully, as a Dodgers fan, came and pulled Snell out of the game. The Dodgers were excited. The relief pitcher came in, and they took that opportunity to just get on top of them and ultimately win their first World Series in 32 years. So they adapted, where Tampa Bay really just played that technical level of baseball. And instead of taking a look at their ace, saying, hey, this guy is really crushing it, going off script, adapting to what was unfolding in front of them, they played that same old metrics, hoping that it would work out, and it didn't. Where the Dodgers, having had played that in the past, realized that was not the way through, made that change, and again won the World Series. So how does that relate to investing? Well, we go into every year at our firm with our investment committee with a very well laid out plan of exactly how we're going to invest, what stocks we think are going to do, what industries we're going to do well, all basically in support of an overall narrative of what we think is going to happen year to year by the market. And I think what's different about our firm, what's different about me as the lead of our investment committee, is I've learned from experience. I, just like the Dodgers, just like we saw with Tampa Bay last night, used to play that really technical level of investing. We make sure we had the right diversification. We always wanted to have some small cap, some large cap, international. And the idea is because this has done well over the long term, you just kind of stick with that strategy and it'll play well for you. The problem is I've been doing this a long time now, and a lot of what a lot of firms are preaching, a lot of what you read in the textbooks, a lot of what's being taught in universities about investing has not worked in 10, 15, 20 years. A lot of our industry is based off of strategy that was developed in the 1950s by a guy named Harry Markowitz, and we're still using that today, even though fundamentally everything has changed significantly. So when people talk today to me about what makes you successful investing, how do you guys continue to stay ahead of your competition? How do you continue to keep clients happy? It really comes down to being able to adapt and not sticking to a strategy just because it's worked in the past, but taking in the data that comes in on a daily, weekly basis and double checking your strategy, going back to that thesis statement that you made for the investments that you're buying and see, is this still valid in today's market? Or has the situation changed? And do I need to adapt my portfolio? Do I need to adapt my strategy? So, case in point, coming into this year, nobody saw what we were going to be heading for with the pandemic. No one was expecting that to happen. And if you said that you were set up for that coming into this year, obviously you're lying. So we didn't expect that to happen. But when we saw that happen, we realized, hey, look, this is a very different environment, different landscape than what we expected. Now, we could have done one or two things, said, hey, let's just stick to our strategy because that's what's worked in the past. Or like we did, we could have went back to the drawing board and said, hey, fundamentally, what has changed? And we realized people were not going to be leaving their houses for a while. We realized that travel was going to slow down, both business and personal. We understood a lot of the generalities of what we're seeing play out in this year. And so when you change the landscape and the environment, that changed the game. And when you change the game, the type of players that are going to be successful are different from the previous game. So if we go from basketball to football, for example, the team that we would put on the court, the players we would put on the court are very different than the team that we would put on the field on a Sunday to play in football, right? So when we saw that happen, we needed to make some changes, right? We needed to make some changes to who was going to play. We needed to make some changes to the outcome. So we took some of the stocks, companies in our portfolio that we didn't think were going to do quite as well. We reduced those positions and we started looking for who the favorable players are going to be. So we looked at companies like CrowdStrike that we've talked about all this year. Why? Because, okay, if people are going to work from home, what's one of the challenges? Well, security, obviously. When you bring laptops into the home and now you have a big enterprise that has people spread out working across the world, you need to make sure that you provide security for your customers, for the integrity of your infrastructure. And so CrowdStrike, we really liked a lot because we said, hey, this is a player that specializes in that endpoint security, very scalable, very affordable, robust solution that people can plug in right away. We looked at it for our own firm. That's a new name that we brought into the portfolio. We also increased our positions in companies like Amazon because obviously if people are going to be stuck at home, they're going to be ordering more online. That also lends itself into companies like UPS, for example. And then Zoom. I think Zoom, I've talked about it a long time, is one of those secular type of companies where I think because of what we've seen this year, as companies' bottom line increases because of reduced travel, people not having to spend so much time, away from the efficiencies of work, that's actually done two things. It's increased productivity for companies, but it's also increased the bottom line because of less spending on things like travel and so forth and so on. So as a good investor, just like Dave Roberts and the Dodgers did, if something is not working, if the strategy in which you are basically building your portfolio and your team to win the game on is not working, you have to adapt to that. And if you're just someone who's going to stay there, stay the course and say, hey, this worked over the last 20 to 30 years, I can tell you you're going to get run over. Because one thing about today, the speed of change is infinitely faster than it was before. People are adapting faster than before. Technology today is enabling people to really be able to pivot. So as an investor, we really want to focus on that ability to adapt. Don't get stuck in what worked over the last 20 to 30 years. If something's not working, go back to the drawing board. And this brings up a good point. One of the main things that I see individual investors do that really derails them is they stick with losers way too long. and they actually cut their winners way too early, meaning let's say they bought a stock like CrowdStrike at 60, it went up to 80, and they said, wow, that's really great. They feel good about themselves. They take that profit, yet the stock still had a tremendous amount of leeway to go. So they took that win because it made them feel good about themselves, where they might buy a company that really isn't the right company. Let's say they bought something like American Airlines. And even though we realize a company like American Airlines today is significantly challenged because of the current environment, they might have been down $3 or $4, and they didn't want to admit to themselves that they were wrong. They didn't want to admit to themselves that this position no longer was going to be in a space where it was going to be able to succeed in the current environment. Instead of taking that $2 to $3 loss, they let the stock drop 15, 20 points, and they're still holding on to it, waiting for something better. Whereas if they would have just adapted, if they would have pivoted, they would have been in a much better place to take that money and put it into a winning position. And like Darwin says, one thing to always remember, it's not the strongest of the species that survive, but it's the most adaptable. So when it comes to investing, when you're putting your thesis together, when you're putting your portfolio together, you need to keep your ear to the ground and your eyes open to see, are the reasons, is the landscape that you bought that stock to be successful and still the same? Does that company still executing on the metrics it needed to be successful? And if the answer is no, you need to cut your loss and find out something that will be much more successful to put your money in. So that's the word for the day, is adapt. As an investor, if you want to succeed, you need to be able to adapt to the environment around you. Abraham Luda, this is Wealth Talk. If you haven't subscribed yet, please click the bottom below. Subscribe to our channel. We have new content every week just like this to help keep you as an informed investor to make better decisions for your wealth.